Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Welcome everyone to 2023, the first recorded version of Investing Insights. This is where we guide you through the conflicting signals that we're seeing in the property market. And this is going to be really interesting with economists divided as to how the market's panned out, whether we're at the bottom or are we approaching the bottom, with the Reserve Bank sending mixed signals in terms of whether we're at the top of the rate rise cycle or there's more to come. And the information on the ground is very different to what the economists are saying. But before we do that, welcome back to Steve Waters. Steve, I believe that you spent the last month and a half on your boat counting and accounting for the millions that you've gained in equity over the last 2 years and how you're going to spend it this year.
No, that's not quite the story. I was accounting for how many litres of fuel I used and how expensive it is now, which is all part of the inflationary environment that we're in. But no, it was a good break. It's good to be back.
Yes, it is.
I always love those moments of flux, you know, where there is conflicting information and Peter's saying this and Mary's saying that. And but in the middle is where that grey area is, where I guess people will make decisions based on their own scenario, and some will do very well and some perhaps won't.
Absolutely.
But it's always that moment of flux. Once again, that's exciting.
Yeah, and we find that take 2023 away, even at any point in time in our investing journey, when there is conflicting information, when there is a little bit of uncertainty in the market, the people that lose money are the ones that react out of fear and out of poor information and do a knee-jerk reaction, whereas the people that actually take assertive action, they really set themselves up for the next cycle of property where we set out the foundation and the benefits of what you do in this period is reaped in the following years as the cycle turns.
It's a good point, because if you're inactive, that's where the issue is. And being active doesn't, in our asset class, mean that you're going out there and you're purchasing, but it just means you are part of the process. You should be part of the process. Once again, not necessarily purchasing, but you should be adjusting rates, adjusting incomes in terms of rent, insurances, whatever you need to do to stay in tune with the pulse of your own situation, but also the pulse of the broader macro point of view as well. But I think if we go back and look at these different crises through the years, the biggest transfer of wealth have happened at that point in time.
Yes, it has.
Every single time. And even in our, I guess, in the scheme of things, short history of doing what we do and being investors, so 26 years now. 26 years. Yeah. Well, you are older. It's 23, 24 for me. And even as a consultancy service of over 15 years, we have, I guess in hindsight, been fortunate enough to experience these different markets, and some were pretty ordinary and some were fantastic. But during those times of, I guess, negative sentiment, during those times of economic hard times, was when the real wealth was created, because it wasn't a matter of buy it today, you're a millionaire tomorrow. It was about controlling the good asset when most people couldn't.
And setting the pieces up.
Setting the pieces of the jigsaw puzzle together for the future, and even go back as far as the GFC, which is the biggest one potentially. It wasn't that long ago in the scheme of things, but also it didn't last that long when you look back at it retrospectively. And when I refer to it didn't last that long, I mean the sequence of events in terms of the time it hit, to what the market did, to how it ebbed sideways, to how it recovered and continued.
And it wasn't as evident at the time while it was playing out, right?
When you look back,
you can see, right? And you can see that success leaves clues along the way, right? So the people that navigated that time of the market, that time of the cycle, did really well by taking assertive action. And sometimes the assertive action could very well be that you shuffle around what you've already got as opposed to buying more properties, or as opposed to seeing whether you can qualify for more finance. And again, like you said earlier, it comes back to what your circumstances are and how you can make good of the market as it plays out. The biggest concern that we see, and if you look at the media articles and if you look at the property reporters that are reaching out to us, is how can we afford to hold on, or is property affordable? The reality of it, if you look at it historically, and I know, yes, we're talking about interest rates, the fastest rate rise it has had in the last 70 odd years. And that's significant, right? So that includes the 19 percenters.
True.
Yes.
Yeah.
So, when you look at that, historically, high interest rates have been around for 18 to 24 months before lending eases out. The rates may not come down, but lending eases out. The cost to hold starts to improve because rents do go up. And if you're looking at, say, what's the playing field looking like in 2023, it's not about cash flow. Well, it is, but it's not. So what I mean by that is that you can't fixate on getting cash flow positive properties. You do need to fixate on, can you afford to hold on to the property, the debt, with the cash flow that you have available in the household for the next 2 years, because that's when you're going to see some major growth.
It's a good point, because most people are fixated on, I guess, what the property produces in our asset field, which is, let's be clear, that's a very, very important piece of the puzzle.
equation,
But so too is the household budget, and how you can fix, repair, increase, whatever it may be to you, so that you're in a position to be able to do something or nothing, but do nothing comfortably. And that's where the inflection point is, right? Because that all runs back down into consumer confidence, which then flows and ebbs throughout the economy, and that starts to spin the wheels of the economy. And if we look at some of that, I guess, that conflicting information that we're seeing in the market today, and the market is the media market, then there's the data market, and then there's the ground truth element. So we have if we look at the different reports in and around consumer confidence, it's a very low point. There's no doubt about that. There are certain segments of the consumer market that is struggling, without doubt, can't be argued. It's a fact. And so consumer confidence is very, very low. And as a result of that, which, side note, that's what the RBA want. In a very simplistic view, they want you to hurt. They want you to stop spending so we can get inflation under control. But there's also an element out there that are potentially more sophisticated thinkers, for want of a better way to describe it, that are seeing an opportunity. Now, the opportunity might not be right here, right now, but they're in the work-up stage to be in a position to take advantage of whatever that opportunity looks like to them. And I'm not necessarily talking about property. It could be shares, business, alpacas, whatever it may be. But they're not letting the current circumstances dictate where they're going to end up. It just might be a moment in time to consolidate, rejig, replan, re-strategize to be in a position to take advantage in the future. So the consumer confidence in some parts of the market is low, in some parts it's tracked sideways, and there are some out there rubbing their hands with glee. Right? Always the case. Then we look at how that is translated into data, and the data is showing us that retail spend is off somewhat, not as much as what the RBA would like. It's showing us that people are starting to tighten the belts, which is what the RBA wants. But on the ground, I'm seeing plenty of people still splash cash. Now, whether that's from a form of stupidity or whether that's because they are extremely confident in their own unique position, whatever that looks like. I'm not talking about property here. I'm talking about consumer goods, big ticket items, boats, cars, planes, and the like. They're confident enough in their position. Now, whether they've got big buffers, sorry, Warren, whether they've got big buffers, whether they've got ample credit, whether they're cashed up, who knows? But they're still spending it. And then we go to the rawest form in our asset class, which is, I guess, what the media are telling us, and in combination with what the data is showing us, where there's been some pretty significant price falls in certain areas of the country, and I sort of emphasise certain areas, and that the market is generally in free fall according to the meter.
To the data.
To the data, correct, yeah. But on the ground, that's not the case.
No, it's not.
So if we look at a conflicting piece of data in and around that, we have versus ground truth. There are parts of the country where they're at record pace price drops, yet some of our team were out at open homes last weekend where there was in excess of 50 people at the open home and the property sold on the day for $65,000 more than asking price, which as a percentage representation of the initial asking price, which was $435,000, that's a good chunk.
Yep.
So there's confidence there. Now, I think it was an investor that bought it. So an investor understands, I guess, the holistic view or top down of what's happening in the economy. And yet there are others that are definitely struggling in terms of mortgage arrears, albeit we're nowhere near what we were at the GFC.
Yep.
It's only a blip at this stage, except for those that are, then it's a real thing. But the interesting thing is, in terms of conflicting data, there is some elements of truth to it. In fact, there's probably 50% of elements of truth to it. And it's the stuff that we, from a commercially orientated view, should be, I guess, happy about, and that is the vacancy rate. Now, I don't want to be smashed by the tenants' unions and things like that when it's not about being an evil landlord or a slumlord or anything like that. In fact, further from the truth. But we're at record low vacancy rates. And we've talked about this for 5 years now, that this point in time will happen. Record low since they've kept records, which is something that is only going to get worse. Yeah. So as landlords, those that have experienced this before, that have their buffers in place, that have their serviceability packaged, and who have had a strategy and they've prepared for this moment in time, it's probably not a bad time to entertain investing.
Absolutely. And the old adage of, you buy when everyone else is fearful and you sell when everyone else is greedy, in that sense, right? So let's explore the moving parts that we are seeing that are causing the conflict in terms of what's being reported in the media, what's being portrayed by experts, economists, and so forth, right? And the reality of it is that if you look at what's the mindset, so let's bring it down to government levels, right? So federal government, what's their stake in the property market? Since it's property podcast, we talk about properties. What's their stake in the property market? So the negative gearing, they give a little bit away, but they claw back a whole lot when they take back the capital gains tax, right? And of course, as people have that wealth effect, there's more expenditure, there's buoyancy in the market, there's consumer confidence, and therefore the economy becomes robust. Now, as we went into COVID and the rates got lower, and people realized that, hang on, COVID could actually be an opportunity. My costs are down, I'm not traveling, let's spend.
Credit is free flowing.
Credit is free flowing. So the economy became really robust, and therefore inflation started to creep up as well because of supply chain constraints and the expenditure, right? The free fall expenditure of people because they had surplus money sitting in the offset account they needed to spend. It made them feel good. They brought forward plans of renovation. They brought forward plans of purchases, the amount of new cars that have been bought, all of those sort of things. That created a runaway economy, which we needed to quell, right? So therefore, Reserve Bank stepped in, tried to quell inflation by raising the cost of money. When you come down then to state level, you'd argue that roughly 30%, maybe a little bit less, of their revenue is from stamp duty and various property tax like land tax and so forth, right? And right down to council level, your contributions and so forth. So they made a stack of money, and now there's a bit of change afoot, particularly in New South Wales. We're toying with the idea of getting rid of the upfront cost and bringing in a more longer term cost in terms of property tax.
The reoccurring income model.
That's right. Yeah, perfect model.
Yeah, it's great.
It's great. And more so fool's gold than anything else when you really look at it. But all in all, that's created the wealth effect that created a lot of expenditure. And now with the interest rates going up and the new cliff edge that's coming in with, I think Macquarie took out a survey that around 800,000 fixed loans will come off their fixed rates this year. So that's a big cliff edge. So they'll come off, say, let's say 2.5% to say 5.2. Huge amount of increase in terms of repayments. And when you take that into account, so obviously it's slowing down from that consumer point of view. And naturally, these governments, the various governments, will bring in incentives to re-trigger that big chunk of their income. How are they going to do that? Entice people to buy more properties. How are they going to do that? Maybe tinker the first homeowners grant, maybe make investing a little bit more easier, have some grants like the WA government did during COVID of, you build a house, I will give you 20K, no questions asked, those sort of things. And then on top of that, then we've now got all of these banks that make money by lending out money. And right now they can't as much. So they will then start bringing out new products. They will put pressure on APRA to reduce the assessment rate like we were talking about earlier. And that will reignite the market. So my belief is that this property downturn in inverted commas is going to be very short-lived because we've got too much at stake from an economy point of view to allow it to drift. Now, we're not going to go back into a boom, but it'll get into a stabilization mode.
It's a good point because in and around a few things, the booms aren't at the end of every market. And the media has this bad habit of saying something is either booming or it's busting.
It's either on or off.
Yeah. There's never a moment of normality, which is what most of the market does most of the time. It does its gradual flex, I get. And then we get these random instances such as COVID, end of GFC, first home grant back in 2000, and we have these booms. And then even if we look at the subsets, like you go back to WA 15 years, 17 years ago, because of the mining boom and different areas, same story, right? So there's never this period of normality, which I believe we'll be entering into. Yep. There'll be certain areas that outperform the market for sure, and there'll be certain areas that underperform because of various points or factors, I guess. The other thing I wanted to talk about that you mentioned was this cliff face in and around fixed interest rates, right? And I know plenty of people that are coming from 1.99 on their principal paces, which will end up at 5%, right? So it's a huge difference. But there's also been in excess of 50% of those fixed rates that have already gone into variable.
Yes.
Right? And that's been absorbed. So if we use the future as if we use what's happened recently as a bit of a pathway to the future, the question is, will the economy or will the borrower absorb that? Yes, it'll be a rude shock to the system. There's no doubt, but they'd be thinking about it.
Yeah, absolutely. Now. Especially going into this market with a lot of savings behind us, right? It's a huge amount of savings that we've got in our offset accounts because of COVID, and that's allowed that buffering to happen. And the informed homeowner, and I use the word homeowner quite deliberately, they would know that, hang on, rates may come down, rates will come down. I need to just hold on. I've got the buffer. I don't need to get into a distress sale. So this thought process that this year will be a bloodbath, actually I think is incorrect. And that's the conflicting signal here in the sense that, yes, the data says that there will be, but we need to take into account that people have come in with a lot of savings. A lot of people have got cost efficiencies. Yeah,
correct. And I read I can't remember which major bank it was the other day, but their research showed within their loan book that the average person with a home loan was some 15 to 20 months ahead of their mortgages.
So we've got at least 20 months up our sleeve then.
When you look at it via an offset or whatever it may be, thanks to what we've experienced through COVID. So technically / theoretically, people will start to absorb that at the higher cost of living, the higher cost of mortgages, and before they have the necessity to sell.
Yep.
And as a result of that, what we have today as a data point, which we're seeing as the truth in behind at ground level, is less stock on market.
Yep.
Right? Generally speaking.
Otherwise, if you looked at what the data indicators are, there should be stacks and stacks of properties in the market right now.
There should be rivers of blood.
Yep.
And there should be record levels of inventory on the market. And there isn't. It is at lows right? And because people say, well, hang on, if I don't need to sell, why would I sell? I've got a bit of a war chest. I might ride this out for a given amount of time before I start to seriously think about it. The other thing you mentioned, which coincidentally, I've got some numbers here, in and around home owners. And we've talked before about how we believe people are far more sophisticated and entrepreneurial today than what they were 10 years ago, probably 5 times more than what they were 20 years ago, and so the scale goes, yeah? And so people have the ability, thanks to technology, to perhaps create other forms of income or have more education, which is a key piece to all of this, yeah? But I think it was NAB did a survey to potential home owners, or first home owners specifically, yeah? So this comes back to our point around the desire is still there, contrary to what the media says, contrary to what the data says. The desire is still there, but the ability is not via the increased servicing capacity. But so they did a survey of buyers aged between 18 to 29 years of age and found, right, and this is where people are willing to sacrifice, 43% were willing to reduce their purchase price.
There you go.
So therefore in line with what they can afford, right, in the bank's eyes. 39% were willing to buy with another person, so thinking outside the square. So whether that person is a partner, a friend, family member, whatever it may be. 33% would settle for a smaller block. So they don't want the big quarter-acre block. Perhaps they don't even want the 600 square metre block. We'll take the 400 square metre block. And we see evidence of that throughout the country in terms of these smaller subdivisions and how they sell very easily. 30% are willing to buy in a non-preferred location.
That's interesting, isn't it?
Very, yeah. Now, so if we, I guess, look a little deeper into that, why would that be? My guess is because of COVID, the work from home environment, in combination with technology, don't need to live in postcode 2000, 3000, 4000 as close to the CBD office space because things have changed.
From anywhere.
Correct. And 23% were willing to buy an apartment instead of a house. So I guess that would roll into with affordability and location as well. Conversely, only 7% were not prepared to make any compromise.
So a very small number.
Very small number, right? So I remember years ago when we were doing I'm probably talking about 7 or 8 years ago, maybe 10. I think we were talking on stage somewhere or whatever it was, and we were saying, someone stood up and said, who was quite a bit older than us, different generation, saying, look, when we first bought a house, we did whatever it took. We worked 15 jobs. We didn't have curtains. We certainly didn't have flat screen televisions in every single room and an Xbox to boot, and no flash cars, no jet skis, no boats. We did what it took to put our stake in the ground, and we slowly but surely started to accumulate these other niceties, so to speak, which I guess there had some fairness to that, right? And essentially what they were saying is today's generation, which back then included you and I, weren't prepared to sacrifice. Yet if we fast forward to today and people's understanding of what a home does for them, or the asset class does for them, people are starting to now ebb back the other way and make those sacrifices. They still might have the flat screen tellies, but they'll sacrifice location, they'll sacrifice space, and certainly purchase price.
Yeah.
Now, why purchase price is important is because it blows the theory, the myth, the narrative from certain people within the market that the best growing properties are the most expensive ones and are closest to the CBD. Which we've never advocated, we've never believed in that, and we've been quite vocal about it. We've always believed the affordable corridors, and affordability is between the ears, or what do you make of it? But if people are willing now to be able to purchase within their, scale down their desires in terms of that price bracket to get a foot in the market, well then the affordable corridors, just like the GFC, start to, I guess, outperform at the initial stages.
And that's usually market recovery.
Correct.
That's what market recovery normally looks like, right? Now, there's really a very strong data set out there saying that property prices have gone down in some areas 12, 15%, other areas 2%. And when you really look at it, right, this is what the data does not give. When we went through COVID, so the first quarter of 2020, people sat back and said, oh, I don't know what this looks like. I'm not sure how it's going to pan out. Then reality set in to say, well, yeah, it's not that bad. I can actually buy something. So people started buying, and it started that runaway train of, I buy today, by the time I settle, my property is worth a lot more. Right? So there's massive equity being built. So people jumped in with combined with the lower rate. They didn't mind paying $15,000, $150,000, $200,000 more than what the property really was worth. And the bank jumped on board on that fallacy, saying, you know what? Yeah, I can see that value. Yeah, I can see that value. Here's your money. Yeah, you can afford it. So now that the market is sort of is flattening out, where the urgency to buy has gone out, people have stopped paying the premium, which is the actual price reduction in most areas. It's not that the values have fallen, the urgency to purchase has gone out of the market. So what we call the giggle money in the market has gone out. So this is something that the data can't really accurately say, because data is just a set of numbers, it's just a set of statistics. It doesn't take into account the human element that's involved in a moving market, in the various moving parts of that make a market, that make an economy, that comes from the psyche of the investor, the homeowner, where we are influenced not just by what the media is portraying, but what Joe Blow down the street has said.
The broke brother-in-law.
Yeah, that's it. Yeah, the broke brother-in-law. And also, us vying off the success or failure, or the perceived, hey, it's really hard for me conversation, to say, you know what, I can do this, or I better not do this.
Yeah, that's a good point. And I guess when we explore that a little further in terms of the data, I guess being a little distorted would be a way to describe it. I know of some suburbs in Sydney, as an example, which had, 40 to 50% growth over that COVID period, which is just ridiculous.
Unprecedented.
Yeah, ridiculous.
We have not seen this in our investing lifetime.
Yes, we have.
Oh, yeah, 2000.
2000,
yes.
2001, which we often refer to as the doubling year, because it did double.
It did.
But so let's call it between 40 and 50% over this COVID period, which is well in excess of the historical averages. And as you referred to, there was a whole heap of giggle money in there. And there were properties in there that should have never have probably sold. So underneath high tension power lines,
which we steered well clear.
We're well clear of super. I'm going to call them challenged streets.
Mm-hmm.
And
that's
flood.
Very diplomatic.
It was, wasn't it? It's and say flood affected.
Yes.
Like realistically goes underwater. So you had the combination of those three. You could have still put $1 million on that as a figure, and had 30 people fighting over it. And some of them sold. A lot of them sold. Yeah. You fast forward to today, this short, call it 12 to 18 months. Now you can't give those away. And the people... Unless you discount heavily. So they're capitulating in terms of the price. And the data can't distinguish, well, that's a good street, bad house, bad scape, good scape. It just sees a number.
And therein comes the headline, properties have come down by 25%.
Correct, right? Yeah. Now... And it starts to affect, you get enough of those and it affects everything else in and around it in terms of those data sets, I guess. But in the same suburb, or maybe even the suburb next to it, bringing in real examples, there's been very little slippage in terms of the value of the property, because it's not under power lines, it doesn't go underwater, and it's not in a bad streetscape area, so to speak. So people still recognise value, there's still the desire to live there, and they're willing to pay what they can afford between what they know they can afford and what the banks tell them what they can afford. And I guess that brings up a point in and around affordability and what you mentioned earlier on with, say, the buffer rate. If the buffer rate reduces from 3% to 2%, because it's not fit for purpose anymore. So let's use that as an example. The buffer rate reduces from 3% to 2%. That adds, in my very quick bad mathematical calculations, and I'm certainly not a broker, but probably around about 10% increase to serviceability.
Which is huge.
It's massive, not to mention the inflationary pressures in and around wages and what have you. and if it's an investor, the rental income as well, which is tacked on as income. But if we use that as a I guess a piece of information or an example, and we go back to 2020, or even before that, go back to when APRA pulled the handbrake up and made it nigh impossible to borrow money if you had any type of complexity around you, I guess, or even for the normal person. So the ability to borrow X reduced substantially, and what we saw in certain markets was that the price adjusted downwards accordingly, because that's what I've got to spend as a majority, so that's where the market settled. Conversely, we saw as COVID kicked, or the handbrake released, ScoMo won the unwinnable, and almost within months, the prices adjusted accordingly upwards, because now people could borrow more money.
It's just confidence.
Correct. And ability, right, which is the big piece here. And I guess the point I'm trying to make. And then you go to COVID. Free-flowing credit, record low rates.
Lots of savings.
And everyone just bought, and the prices went accordingly. Now we've got the reverse effect. Serviceability is down, and the markets are adjusting themselves to where that affordability point is, I guess. So you can have population growth, you can have infrastructure, you can have the challenges of the cost of money, but ultimately it's going to be how much you can get.
Yeah. The credit.
It's the flow of credit.
And if you look back, so GFC is a good example, and I know we keep referring back to it, and for those that haven't been around in the investing circles or home ownership circles during GFC, it's a really good yardstick to use, because it had all of the moving parts that we've got today, except dressed differently. So if you look at the GFC, the interest rates that we were paying was 7.5%. Right?
Up to 9.
Up to 9% even. I remember having a 9.5% loan.
Yeah.
Yet the spread, which was the rent coming in and the money going out, wasn't as significantly different to what it is today. Perhaps it was a bit better back then. So we've still got a lot of room for movement in terms of the ability to hold onto debt through cash flow. It's just that we've just come off a very, very low interest rate base. And so it feels like the world's ended. But all we've really done is barrel back to normalcy. And perhaps only now with this recent interest rate rise, we're starting to push beyond that. Even if you go back to the John Howard days, the cash rate was 5%. Right? So we are 3.25 at the moment. So there's still a whole room for movement. And the beauty of things right now is that there are a lot more tools to keep us informed in that sense, so which is a good and bad thing, because it can create fear as well. And importantly, finance is a lot more easier in comparison to when it was back then, because finance was not as free-flowing as it is right now. And so long as you are able to afford the cash flow to bankroll the portfolio, bankroll your budget for the next 12, maybe perhaps 24 months, we'd come out the other side by the time the cash flow constraint would ease out significantly. We might not get rate decreases, but rates would stabilize. Rents would certainly go up. The inflationary pressures may reduce. And what's harder to hold right now would become quite easy to hold in comparison. So let's say it's costing you $500 a week to hold your portfolio right now. It might drop down to $350 at that point in time, which is a big reduction when you really look at it. So it's just having that planned approach and looking at the worst case scenario to say, what can I do to get in the cost efficiencies within the household budget? And I'm not saying stop living, right? You still need to, investing needs to happen in the background, life needs to happen in the forefront within reason. So we need to look at those cost efficiencies. We need to look at, okay, can we turn, if we can qualify once the assessment rates come down, can we turn our principal and interest back into interest only for a little while so that we can weather this cash flow constraint period? Because what is on the other side of this scenario is some fairly strong growth.
It's a good way to put it. What's on the other side of this scenario is actually bloody exciting. We just got to get there.
Yep. And set ourselves up. Set up the pieces. If you're playing chess, you're getting these pieces up to attack, but you're still taking a defensive approach in that sense as well.
Yeah, and I guess it reminds me of the expression, debt's a great servant but a very bad master. And what that really meant, and we've talked about that before, is in a short way to explain it is, when you're accumulating debt, you need to look at the downside. You need to look at the what ifs. So if you were continually doing, as an example, your calculations on taking $1 million worth of debt at 1.99%, and that's going to be it forever, regardless of what the RBA governor said. Interest rates won't go up till 2024. Right? You had to ignore that. You had to do your calculus
on normal rates.
Because they were emergency levels and what have you, and have a plan for when that did happen. And so we often talk about, every single podcast, this one's no different, be liquid all the time, have the buffers in place, and always be in a situation where you can sleep at night should the worst case happen. And unfortunately, I think there is a big cohort of people within the general economy that haven't done so. Maybe because it was just naivety where they've never experienced it before, maybe they didn't have the right people around them, whatever it may have been. And I think it'll be those that have accumulated non-productive debt that get themselves in trouble.
Absolutely. And if you're looking at buying property, whether it's a house, your home, or an investment property, it still comes back to cash flow, and you need to look at it from a viewpoint that the growth that we've had in the last 2 years is a little bit abnormal, right? It does not happen that fast, not usually. And when we get into the next couple of years, there won't be as significant a growth. It needs to go and settle back into its normal cycles of growth patterns. Perhaps those growth cycles will be a bit foreshortened because you'll get faster upward surge, because we've created new ceilings in each area, right?
Correct.
And so it'll barrel back up to those ceilings if it slips back. And if there's enough momentum, it'll break past that ceiling. Again, depending on credit and depending on market confidence. So whatever you're looking at buying, your approach should be that, can I hold on to this for the next foreseeable future, perhaps 24 months? And I'm not after immediate fast growth. I'm playing the medium to long-term game, as property should be. And that will give me good standing in terms of how much value I'll be able to add into the portfolio. Again, if I flip back to the GFC, you and I were buying properties left, right, and center, and we're buying them at discounts and sometimes at value because we could see the opportunity around that property. And holding it through that one cycle meant that we added immense value, both from equity position, lendability, because the lenders could see stacks of equity, and equally importantly, the rental income skyrocketed. Yeah,
correct. It's funny that you should say that, because I think when in and around that growth piece and the market changing, I think where people get carried away is, and especially now because of the COVID, I guess, growth trend in everything, is that there's a deal of people out there. There's a portion of people out there that just think that it goes up every year.
Does not.
And that it goes up magnificently every year, and that they might even buy into the property doubles every 7 years piece, some lower. I think what people need to understand, they should believe in it and they should account for it, is that we just, to some degree, for I guess a level of security, just look at our long-term averages, right? Now, yes, there'll be places that outdo and perform better, and their averages will grow because of whatever the reason, and some go the other way. But I think it's around about 6.3%.
Yep.
Yeah, compound annual growth. If you just do your maths on that and know that some years you'll get 12%, you might even get 20, that you'll give back 7, you'll get nothing for 4, and so the cycle goes, but it will average out at that. That's how simple it can be. Good valued properties, well-located properties, when you can afford to do so, when the bank will give you the money to do so, and activate. It can be that simple without trying to overcomplicate it. And
don't make it exciting.
Don't make it exciting. No. The exciting bit, I guess, is
10 years down the track is the exciting bit.
It is, and it creeps up.
Yep.
It creeps up very quickly. I know that sounds, it contradicts itself, but it happens in the background, and you get to that point, you go, wow, like that was pretty cool. It was very hard for when I first started. It was very hard for me to get my head around that. You know, what property's going to double? Like this thing here is going to be worth $210,000 going back in the day, and it did. You know, it all the way through to today, which is 800,000. So it's done pretty well over the last 23 odd years. But I think if we keep it simple, don't try and, I guess, go back to one of our podcasts just at the end of last year about timing and time in the market, how people so misunderstand that terminology about timing and time in. They get it so wrong. Not only do the majority of people get it wrong, the media get it wrong, a lot of advisors get it wrong. Go back and listen to the podcast and you'll see what we're talking about. Exciting.
Yeah, it is. So this year, if you look at it from an investing point of view, there are a few things that we need to look at. One, obviously, is still, like we say in all podcasts, go back to the fundamentals. And what are the fundamentals? Cash flow management, more to the point. The ability to remain liquid in terms of mortgages. So what do I mean by that? Don't be silly and get yourself into a bind where there is no room for movement. In other words, don't get into a position where you've got absolutely no equity to maneuver in that sense. Now, some of it is beyond your control because you can't control the market as such. Then the third thing really is don't be silly and don't just buy wholesale into let's get into the market because there's going to be doom and gloom and buy anything. It needs to still be within the realms of good management in terms of cash flow within your household. So the type of property in the next perhaps 12 to 18 months really is not about cash flow. It's about squaring away. You've got to start thinking like a developer, right? You've got to square away the land and wait for the wave to come, right? Except you're not buying these big blocks of land. You're buying good properties that if things don't go your way, you're able to offload to the mum and dad homeowner or investor and able to walk away with your money by doing something to the property, obviously, right? And if you took that approach, you'll be able to navigate this next 12 to 18 months of conflicting signals quite safely and come out on the other side with a very strong foundation of properties that you could come back to do something with, whether it is to sell down, whether it is to revamp, whether it is to develop, or whether it is just to set and forget. And that'll then benefit from the next upswing of growth, however long that may be.
And that takes time.
Yes.
Yeah. It's a slow process, but quitting won't speed it up.
No.
At all.
No.
So we need to believe in the process, trust in the process, and knows that it takes time. What about because we are running out of time, speaking of, there's that narrative out there that real estate is a great hedge against inflation. Do you buy into that?
Not really. Yeah. Look, there's arguments to both sides of it. I look at it in the sense that if property prices are going up quite significantly, people spend quite freely, and therefore it does have that upward tick on inflation, right? And if property prices seem to be coming down, people tend to step back because the wealth effect, and there's lesser spending, which then puts a downward pressure on inflation.
Yeah, and it's the erosion of the dollar value.
Yes.
Ultimately, at the end of the day. And I guess one of the last things I want to quickly reference is back to the federal budget in and around solving the lack of dwellings, roofs overhead that we have throughout Australia. And I was reading a report on one of the large superannuation companies who were entertaining becoming involved, and we discussed that before, why it'd be so good for them from their point of view to be able to get involved in terms of let's classify it as social housing or affordable housing, and how the government was going to become involved and as well as a stakeholder, so to speak, and private enterprise. But if building social housing was so lucrative, then the private sector would have been involved years ago.
Absolutely, they would have been. Yes.
Right? They're not, the private sector, the superannuation funds are not going into this to lose money. They've got a responsibility to the fund holders, to the shareholders, and everybody else involved. So I'm out in terms of the jury is out on whether it'll even get off the ground in its what was hoped that it would in that shape or form. And even if it does, we know that's years to come yet. We have the record levels of immigration, or almost record levels of immigration, and certainly getting back to pre-pandemic population growth levels. We know the construction industry is still struggling massively. We know that new home building starts finance has fallen off the side of a cliff.
Significantly.
Yeah. We know that we're undersupplied, so where to from here?
Yeah.
So where's the magic bullet? And this goes, I guess, back round to your piece in and around government intervention or incentivisation, whether it be via first homeowner grants, tax concessions, which I don't think will happen, federally and both from a state level, to entice or encourage investors, the private investor, the retail investor, to re-enter the market is the only way out of this.
Yeah, absolutely.
Because it's instant.
Yeah, it's instant. And one of the easiest ways is to get rid of all the cost barriers of brand new property, right? Because we need more properties, right?
Yeah.
It's not about established properties, but brand new properties. So get rid of all the cost barriers. So what are the cost barriers? It's all the federal and government
state level red tape.
So a big example would be your private open space contributions at council level, which is paid by the developer. If you got rid of that, the developer can charge less, in theory.
It won't happen.
But we need to start looking at things differently from a governance point of view to make this easier, whether it is via grant or whether it's via incentive, so that people can start building more properties.
And that comes down to zoning.
Yes.
As well, so a rezoning of open land. And if anyone in state government's listening, I've got some. You can rezone that for me tomorrow. I'll help you out. So there's a lot of moving parts here, Vic, and I think it's a good subject. That I guess the conflicting information in and around for 2023, and you could almost roll 2024 in that. But
absolutely.
Yeah, as we've said before, the days are long, but the years are short. So much can happen in the next 12 months, which can turn a market round very, very quickly, or crash it, whatever it may be. And there are so many things that are out of our hands.
It is very fluid.
Yeah.
So if you found that interesting, or if you thought that you needed more information, you needed our expertise to help you through this maze this year, reach out to us via our website. There's a contact us form. There's a bit of a process, obviously, to get a piece of mine and Steve's time. You can actually talk to us. Melissa Matheson from our office, she's a very well-versed property investor. She's the first point of contact, and her role is to get you ready for a meeting with us, so that when you do sit down with us, you are able to get the best out of our knowledge, and you walk away with a clear guideline as to what you need to do, or whether you don't need to do anything because it's not safe, or you just don't need to do because you're so well set up. And it does take a little bit of time to get to our diary, but we can guide you through all of that. And certainly if you're new to our podcast, do subscribe, follow us, and follow us on our Facebook Lives. Go to our older versions of these broadcasts, because there is a whole lot of information that is good, solid information that can help you through this year and keep you safe.
That's it?
That's it.
No, right. I was waiting for you to say something else, another golden mic drop. No, well, that's it. First one for the year off. Our next one will have Phil Tarrant.
Unfortunately.
I know, right?
Yeah.
Just
you got to carry that bloke.
I know, right? Big shoulders. Phil Tarrant from Smart Property Investment and Momentum Media back on, as we do every second podcast. As you mentioned, we've got our Facebook Lives every second Thursday. A little bit of interaction, or you can listen to it for weeks afterwards. But as Vic mentioned, there's a wealth of knowledge through there in regards to these older podcasts. And I don't know, test to see how accurate we were on our predictions over the years. It's interesting. Once again, thanks everybody for tuning in. Give us a thumbs up, give us a like, and we will catch you next time.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.